Hello, what I'd like to do in this video is take you through some of the things you can do with the information we gathered from the financial statements. So we're going to go through ratio analysis. Now, ratio analysis basically can't be used in a vacuum. It needs to be done comparing ratios from period to period. And the purpose of it is to find out about the health of a company. And there's 5 different categories. We're going to go through these different categories. I'm going to be using data from Chevron from the same information that were in lesson 2. Now, it's not just the calculation; it's the interpretation of the information. And there's no standards. You want to compare companies in the same industry. An energy company won't be the same as a technology company. It won't be the same as a manufacturing company. So you want to have similar company structures that you're comparing. And the 5 categories we're going to talk about is liquidity, working capital, capital structure, profitability, and cash adequacy. Now, most of these are used by accountants. However, as engineers, we want to be familiar mostly with liquidity and capital structure. The others are important. I don't want to minimize them, but they're utilized more by accountants than by engineers. So I hinted at this in the last video. The current assets are part of the liquidity ratio. How liquid is the company? And the 2 critical ratios are the current ratio and the acid test ratio. Current assets are basically the ratio of the current assets to the current liabilities. This is off of the balance sheet. Now, the 1.31 for Chevron in 2023 is not necessarily informative at all. You need to compare it over a couple of years. So the 2022 number is important. You see that the liquidity has dropped. You always want to have a ratio greater than 1. That means if all your bills come due tomorrow, you're able to come up with the cash to pay them off. The trend is important. You're accumulating. Is the current ratio increasing? Is it decreasing? It doesn't necessarily make sense to compare a major company like a Chevron with a very small company, because a major company can have a fairly small current ratio, whereas a smaller company needs to have a larger current ratio. The acid test ratio is the same as the current ratio, except you back out the inventory, because when you're grabbing cash, inventory takes a longer time to turn into cash than the receivables. So it's the same ratio again. That should be for 2023. I'm sorry, it's not 2019. I updated all this information. It's 2023. Now, working capital utilization. Now, working capital is cash. So it's the assets that are tied up in the current ratio and the current assets. It's not the hard assets like buildings and machinery. So it's money that you need to run the business, and you want to have this. These ratios. If you manage these well, you can reduce the cash necessary for the business and have more of it invested into harder assets. So, how quickly are you collecting your receivables? Okay, receivables are bills you've sent out, and they're coming in every 36.9 days. You want this number to be small as possible. That means you send out a bill, it gets paid quickly. If this trends to be getting bigger over time, it can be an issue of a problem. Average sales per day is going to be, this is off of the income statement. Okay. inventory turnover. We want to carry, a company wants to carry as small amount of inventory as possible because it just costs to hold it. So you want to turn over your inventory as much as possible. You don't want to be turning your inventory over once a year. It's, and so this is the calculation is basically average ending inventory. This is off of the balance sheet. So this is for 2023 and 2022, and this is the cost of goods sold off of the income statement for 2023. Again, I made the same mistake there. That's 2023, not 2019. Similarly, accounts payable. Not that you want to necessarily do this, but the longer you take to pay your bills, it's like you don't pay your bill the second it comes in. You pay them. It looks like Chevron's paying them every 60 days. That can be a little bit difficult if you have a small supplier. So if you're a small company and you're looking, this would be the flip side of this. This is very similar to the accounts receivable collection. The smaller company, if it's just one company, they're only getting paid every 2 months. Now, you need to dig into the reason why this is happening. Is it happening because of a financial problem, or is it happening just because of a cash management issue? My suspicion is with Chevron, it's a cash management issue. They're doing this on purpose. They could pay it within 30 days. They're just choosing not to. This was for 2023. Working capital turnover. Working capital is the current assets minus current liabilities. So working capital turnover is your sales divided by average working capital. So here's our sales. This is off of the income statement. These two numbers are off of the balance sheet. We want this to be turned over as much as possible. Okay, now, and again, those working capital numbers are typically utilized by accountants and cash managers in a company, not necessarily by engineers. As you move up in a company, the financial ratio, the capital structure financial ratio becomes more important. And there's various numbers here that are used in industry. So I'm giving you the classical accounting numbers. Total debt to equity ratio, that's total debt divided by shareholders' equity. Debt to assets. Number 2 is used a lot more often in industry, debt to assets versus debt to owner's equity. And there's always a question as to what to include into debt. There's an argument that you don't include current liabilities in debt. This is the accounting method for doing it. I would say in industry, I saw long-term liabilities over total assets, used a whole lot more often. Debt to total capitalization, this is where they take out the short-term debt, the current liabilities. And if you look at this, (38.1% includes the current stuff. When you back out the current stuff, it's only 11.1%. So that means that Chevron's pretty stable, and a lot of their liabilities are tied up in current liabilities, which are covered by current assets because they've got current assets in excess of current liabilities by about $8 billion. Now, profitability ratios are usually run off of the income statement, profit and loss statement, and there's the gross margin over revenue, gross margin. This is used a lot, and I want to make one comment. We're going to be analyzing projects, individual projects, later on in the quarter from weeks 3 through 10. But the sum of the individual projects, if we have 100 projects in the company, That makes up this revenue component. And that's why what we're talking about is important. The gross profit, the gross margin of 40% or 41% is a big number. And that's really a very good, this is a good number for most companies. Return on sales, net income over revenue. Return on equity, net income over average equity. Okay, so this is net income is off of the income statement. Equity is off of the balance sheet, so it's the average beginning of 2023 plus the end of 2023 divided by 2. Return on assets is used a lot. Again, it's earnings before interest and taxes divided by average assets. Earnings before interest and taxes is a proxy for what the company's raw assets are able to generate. So if you look at the cash that is being generated before taxes and interest are charged to it, that's the idea of how much earnings power the company has. And then earnings per share, net income divided by number of shares outstanding. Okay, relatively straightforward. Okay, then we're going to look at cash adequacy. And this is, if you look at net, if you compare, cash is king. And if you compare cash flow from operations to net income, we're going to talk about this, but the difference between the two, because in conceptually they ought to be approximately the same, is non-cash deductions. We're going to talk about non-cash deductions in week 7. This is basically depreciation, and it's an accounting number compared to a cash number. Now, so this number is not super important. It gives you an idea of the cash, non-cash deductions. Cash flow from operations, the cash flow for investments. So Chevron's earning $35 billion a year. They're spending $15 billion a year on new investments. Now, this clearly has to be greater than 1 over the long haul. But the idea is that Chevron is spending a lot more money it's earning a lot more money, generating a lot more cash than it's reinvesting in the company. So what are they doing with that money? And is it sustainable? And analysts that are looking at companies as good investments look at this number quite a bit. Cash flow from operations to owner's equity. This gives you an idea of the return on equity, the cash return on equity versus the earnings return on equity. So if I told you the company had a gross margin of 45% and revenue of $2,500, let's back into what their cost of goods sold would be. So gross profit, revenue minus cost of goods sold. Gross margin is the percent gross margin, which is 45%, is your gross margin over revenue. So your gross profit turns out to be $1,125. Your cost of goods sold is $1,375. Now, if you're going to look at the return on sales, if you gave them income of $300, what is their revenue? Okay, so we know the net income of $300. We want to know what the revenue is, and we have the return on sales is given as 9%. Return on sale is net income over revenue, and so you can back into revenue as $3,333. So these 5 categories, let me go back through them. The liquidity, working capital, capital structure, profitability, and cash adequacy are There's a lot of ratios in there, and I asked you to calculate a number of them in the homework. But the one you get to choose the ones you want to calculate in the homework. I feel like the liquidity and capital structure ones are the most important. And then profitability, cash adequacy are second tier, if you will. So liquidity and capital structure are first tier. Profitability and cash adequacy are second tier. Working capital is third tier. From an engineer's perspective, from an accountant's perspective, they're all important.